So first, I want to share, because we talked about stocks so much last week, I want to share how it's going so far. I don't know if you watched the live streams, but the whole SPX idea seems to play quite good, actually. And so do those volatile risk stocks, pretty much all since my entry, all pumping. And I don't know if you guys trade stocks or if you entered with me, but I'm pretty happy. And I really like my edge here on stocks. It's so freaking simple. And I mean, I enter and they immediately like go up 10 to 20%. Obviously, they will also pull back aggressive. So volatility needs to be stomached. But I talked a lot about them in today's stream. So if you're more interested, or if you have questions, you obviously can ask them. But I basically talked about this 20 minutes, so I think it's covered. And so crypto still ranging. TP'd here on AVAX. It's what I do sometimes. TPing, it's not spectacular at 1 hour, but I added back those profits, reducing my risk. Same size, but reduced risk. Yeah, so other than that, we are sitting at this just below this key resistance on ETH and still at this minor resistance on BTC. Yeah, other than that, I said nothing spectacular happened. So I say we focus on the question Ben had in the wish list. And for that, I will move this window. So, you know what, actually, let me pull this one here. I go back to the chart. Now I can do both. Okay. So, if you have a continuation level and price starts forming bearish internal structure, is it still considered a continuation level or does it turn into a reversal setup? So do you maybe have an example for me? I think you talk about crypto, I'm not quite sure. But if you talk about like a continuation level, right? So we have, for example, a bullish breaker block. Then structure forms internally bearish. The question is internally in what sense? So for example, if we take this one here on ETH, just let me be sure you guys can see my screen and everything, right? Yeah. Not that I started explaining because I can see both. So basically, look, if you look at ETH, we have this nuke and leaving this 12-hour block behind, which then also was in premium and everything, but it simply got skipped because above, and now it's pretty much a double hidden here, right? We have now this double hidden, and now it's a bullish level, and internally this could be considered internal structure, right? If I go down to the 1 hour, this is definitely bearish structure, and it's going to be bearish into the level, right? Because it's a reversal edge. We don't trade momentum, we don't trade like trendline stuff or breakouts or whatever. We trade a reversal edge here, and so internal structure is always bearish into the level. And so to be too bearish because of this structure makes no sense, because structure is obviously bearish into the level. The question is, can it reverse from there? And this is the main question. And internal and external always depends on context. So for example, if we don't close, so let's imagine if I do a replay here, this happens, right? We are at this supply and price is rejecting here and then going for the level. How would we treat this? We treat this with care, a little bit more carefully, simply because we have no break of structure. Because technically, price is in a downtrend, even on the 12-hour now. So if I go back to the 12-hour, we have the 12-hour level, right? And we have no close above this structure here, above this. It's technically a downtrend within a higher time frame downtrend. And so this level becomes less optimal. It's as simple as that. It becomes less optimal. Once we get the close above and we pull back, then it's still internally bearish structure into the level, but we have a break of structure here, and this is exactly what happened. So if I remove, or if I go back from, go out of the replay mode, we have the break of structure, and now we get the pullback, which is obviously bearish structure right now, but it's overall, we have a change of character, break of structure, whatever you want to call it. I hope this made sense. So I hope this made sense, and I hope this answers your questions. I just have to hop around on Discord between the different windows so that I can see if you guys write something. You meant on the time frame that is found. Yeah, but still, like, you could look at the 12 hour. If we consider this as swing low, we now like break structure to the downside. It always will be a downtrend into the reverse level, always. But the question is, have we taken out some structure before? Have we changed the trend? Have we changed character before? Yes, we did. So it's still a valid level. It's important that we, on this time frame you look at, we have the break of structure. Now we get the pullback. This makes the level valid, and this makes the level a stronger level. So you can trade them without a break of structure, obviously, but your win rate will go down significantly. AVAX is a weird one right now, because we have not really taken this high. We have broken the trend line. We have not really taken this high, so it's not really a break of structure. But I trade all my altcoins. I don't really care too much about this local structure, to be honest. Why? Because I know they all behave what ETH and BTC are telling them. So I look at BTC and I look at ETH, and ETH is definitely breaking structure and creating a high high. And BTC as well, even though it's a very weak close above, it's creating a higher high and a higher low. And so I treat AVAX basically simply as beta play of majors. And also if I look at Tether dominance, we definitely have a change of structure here. So it started breaking down, making a lower high, making a lower low, even a very good close below. And now we're retesting the 12-hour level here, still in supply. So the whole AVAX idea is based on majors. I don't really care about the local structure of AVAX, to be honest. AVAX has not this break of structure. I traded for one simple reason. I usually don't trade altcoins a lot because they don't offer me anything. It's usually the whole like price action is more erratic, harder to read, oftentimes way harder to find a good entry. But the beauty of AVAX here is that it's lacking behind often. So BTC was confirming its breakup more or less, or breakup structure, and ETH as well. And AVAX was lagging behind so much, so I got my way tighter entry and way better RR, and that's why I chose AVAX in this case. And Ben, I hope this answered your first question about this break of structure. And I said, so don't get like, it's not so important what happens right here. The internal structure is always less important than the external structure, but obviously you want to have an eye on this internal structure as well. But as a reverse ledge, as said, we will always pull back before entering. So it's always technically breaking structure a little bit. Okay, so gonna look for your second question. When exactly does a setup become valid? For example, I know when to enter daily breakup block works. What actually defines the one-day BB setup? Is it the break of structure? Is it what price did beforehand? Is it how price behaves and approaches the level? I just want to understand how to properly differentiate things. Damn English. So I think this is also like a good example here. The 12-hour breakup block became pretty much valid with this break of structure. And now we have the pullback. We have also a pullback into discount. It's aligning at the 618 here, right? So 618. At this double hidden, valid because we have the break of structure. We took this high, we pull back into discount, into this block, makes it valid. I usually like to see it on several time frames. So we have it on 8 hour, we have it on 12 hour, we have it on 6 hour. Makes the level kind of strong. What I don't really like about the level is this big FVG below. So this is why I probably won't trade it, because I treat my setups all like this. So I would target this high and I would cover the whole FVG, and then the RR is not so favorable. Maybe if I'm around and I see local price action develops, I enter. But there are many like confluences why a level would work and why not, or could work. And mainly in crypto, you will find them on majors like Tether dominance, USDC, and BTC and ETH. And if all of them align pretty much, if they all have some kind of level, which they take right now, the setup becomes also stronger. And your question was, when is it valid? The thing is, you could trade every single breaker block. The question then is, what are you aiming for? If you aim for a higher win rate, you should then like be a little more selective, which means you wait for the break of structure. You want to see FIB alignment. You want to have it in discount. You want to see it on several time frames. But as said, you can also be just like Rambo and just uh, using your MG and shooting on every single level you find. It all depends on what kind of trader you want to become. I'm very selective oftentimes, and I have my setups I like to trade. I'm not very convinced about this setup right now, but a lot of things line up because we have the break of structure, we have this level here. We pull back aggressively. Also, according to the higher time frame context, we are in discount. We are at this level here, close to this level. And so it makes sense from a technical perspective. Many things align for this level, and I still don't want to trade it, pretty much. Maybe I will, but right now I'm not very eager. And this is all comes down to what kind of trader you want to be. There are traders that take pretty much every single level they find. I try to refine on higher time frame and align all of my ideas, even though I might execute on lower time frames. I align all of my ideas, try to align them with higher time frame structure, majors, and all of those things. Because this gives me a higher win rate, obviously. But also like means I take less trades. Yeah, and what Andy said, he's not that selective, and the only reason is because he wants to get data. And I was there myself. So I was pretty much taking every single level. But my win rate was not that spectacular then. And after like I collected experience, collected data, and especially like experience in the sense of executing trades, handling the emotions, handling the whole position management stuff, I became more and more selective. But it makes perfect sense to take more trades in the beginning for that reason. Profitability and consistency are good goals, definitely. That the breaker block is at least at 3 time frames, not then, and one of them is higher time frame. Yes, makes sense. Discount and premium, yes. Having a clear target area, also yes. And break of trend line, this is optional. So this is something I like to do if I got the time. So for example, on a 12-hour level, it means you need to drop down to mid and low time frames to do that. And crypto, I don't know what you trade, but crypto can be very unforgiving. So once it starts going, it goes. And the trendline approach is usually not the best for crypto, or it's harder. Let's frame it like that. And oftentimes more confusing and more low time frame action for that. But in the end, you trade crypto, yeah, okay. So everything you wrote down makes perfect sense. And I don't the trendline stuff. I talked about this before. It's pretty much just an execution tactic. It's something you can use that to see if the level just gets melted. Because if the level just gets melted through, you don't wanna like enter the trade, get stopped, and that's it. So the trendline makes sure you avoid that. But it could also, every execution tactic could also lead to like a trade you miss. but a trade, for me, it's always like a trade I miss is not a loss. It's simply like a loss avoided, best case. But again, it comes down to your personality and what you aim for. And a clear target area makes also sense. So what I like to do is always to target the previous swing high, because I always, every swing to me is a range until proven otherwise. So to me, if I take a trade here, that's why I don't like it so much. If I take a trade here, I would aim for this until proven otherwise. So and I do this on every single trade. So sometimes on a very high time frame, if everything aligns and you have like big corrections and everything screams big bullish swing, sometimes I push trades further, or I just take a short instead of TPing on this short, but this is like a different situation often than on spot and stuff like that. But here in this case, on mid and low time frame trading or barely high time frame trading, I would aim for this range high, and that would be my first TP. Or even earlier, you have the 0.5, because price usually always goes back to 0.5. This is how algorithms are programmed. So you have price bouncing here, going to 0.5, nice TP1 area. Let's imagine you play it a little bit tighter, nice TP1 area, TP2, and the rest could be trailed. This is usually how I approach all my positions, and you can apply this knowledge to everything. So for example, if I take a higher time frame idea, so let's take AVAX, I take this as higher time frame idea, and you see how I TP'd at this high, like I said on ETH, it's pretty much the same thing, only that I still have the higher time frame stuff in mind. And I saw that everything is entering resistance right now, so I TP'd and I added this back, right? Because I still trade the higher time frame idea. And I expected at least to go to the 0.5 and front run this slightly. Welcome to altcoins. And my next target is pretty much this supply. And structure on altcoins always looks a bit ugly, but this is my next supply. So I treat this as a range, as my swing high, until proven otherwise. So this is right now basically my best case target, and it's a 3-4 hour trade. And if we break this area, if we go higher, and if majors also tell me we go higher, I can trail something up here. But it's wise to keep local targets and rather TP one time too much than one time too less, obviously. How do you choose the targets? Best case, for example, always wondered that. What I do, for example, I usually target or at least TP1 and GP of current swing, the swing high, low, depending on long short or another break block. Let's say I play high time frame break blocks, weekly daily, I target the next high time frame break block. I think you just answered the question. Yeah, pretty much. So I hope it made sense. If not, you can just tell me. I remember the tweet from Money Tower which said something along the lines, trade the range, not the moon. Yeah, exactly. And the question always is, what is the range? And if I take, for example, a weekly level, especially on altcoins, it becomes, or what was it, a 2 week or something? Yeah, 2 week, 4 week. It's this. It becomes very easy to say, okay, this is my next swing high here. This is my next swing high. The problem is that this is like very high time frame, and altcoins are oftentimes not that forgiving. So I would target something here. And as said, what I like most is targeting the 0.5 of a swing. It's hard to say if we go just for this 0.5 or if we go for this. Right now, majors lining up for maybe a higher time frame reversal, so this could be on the table. So I don't want to rule this out, but I also don't want to round trip all of my gains, but because if we go for this area up here, I already in significant profits. So at least my stop loss should be a premium. I should at least remove the risk, maybe even TP something. And then if we go up here, even better. I often draw my trades like this, because this is now my best, this is my best case target actually for AVAX. I don't expect this to hit. And this is like this is for me the higher time frame range. So this would be really best case up here. And if we go higher, I maybe have some moonbag left or whatever. And on ETH and on BTC, the structure is a little bit clearer. That's why I always recommend beginner traders to like trade majors, because the structure is so much clearer. Because you see, this is like our range high and this is our range low. I mean, it's very obvious. So this is like the higher time frame range, and you can't really like think anything else but that. This is our swing, and it's our swing until proven otherwise. And the mid range here which is the first strong target for a higher time frame trade idea, is here. And the mid-range is to me like also to the 618, so price is rarely perfect, touching this and going down. It's usually like doing a little bit above and a little bit below and wicking again or whatever. And it also aligns with this supply here. And this could also be my local swing. So on lower time frame, it becomes a little more obvious that this also can be our swing, right? So this is like the internal structure basically. And see where we reversed. It was pretty much the 0.5 of this range aligning with this little supply here. And this is no coincidence, right? And the same thing that happens here on lower time frame can and will be happen if we break out from this area. This is what I said last week. If we break out from this area, this 0.5 here in the mid-range becomes very likely. And it's always if then. It's always like I don't never say like, okay, this is going to happen for sure, or I'm aiming for this and I wait for it. No, it's if then. If we break this area, this is likely. If we break this area, range high is likely. If we break this area, this is likely. If we break the range low, we can talk about lower targets. And everything in between, it's a bouncing ball, more or less. And this is what I trade. And that's why if you're a higher time frame trader, you want to have majors align, because if you take higher time frames like all the time every week, you will have a lot of like small bounces here because of the range low and you trade this whatever. But this is rarely something you TP on a higher time frame because you say, okay, this is not what I'm aiming for. And that's why we wait for these big pullbacks and major alignment. For example, here, USDC and USDT back at this range high here. This is very important. And then a higher time frame trade makes sense because we can expect a bigger retracement from there. And this means maybe the really the higher time frame 0.5. From this point on, the RR for a higher time frame trade becomes good instead of like up here or something. Okay, and the last question was, there's something else I'm not clear about. I've read many people recreate monitor charts and try to figure out why a certain level didn't work. Where do they get those reasons from? Right now, it just feels like some setups work and others don't, but I doubt that's the real conclusion. The reality is that some setups work and some don't. It's the probabilistic nature of the market, right? Even the best traders in the world do manage their risk. Why? Because it's also to them, it's probabilities. Maybe some traders maybe increase their win rate to whatever high numbers. I mean, my stock win rate is around 80%, but I'm still obviously need to manage risk. And it's still always a little bit like rolling the dice. You can learn like how to roll the dice, even though it's probably considered cheating. But in the end, the dice has 6 sides, and it's going to be a 1 to 6 chance that you're going to get your number. And in trading, the nice thing is you can increase those probabilities. You can remove some sides of the dice, and so you can increase your win rate and go up 50, 60, 70% if you're good. And obviously then the game becomes more fun and more predictable. But in the end, some levels just don't work. The question is always, what context was it in? That's why we also say you risk lower on lower time frame than you risk on higher time frame. It's as simple as that. And why? Because you add more randomness. You decrease your probabilities if you trade lower time frame. Why? Because price action is erratic. Price action is more random. You have those. I mean, BTC is a very high liquid asset, but sometimes there are traders entering the market that are moving price. And if not they, then maybe the market maker who's targeting them. And you don't know today what traders enter trades tomorrow. They know how people behave in general, but sometimes you have those outliers. And then the market maker says, hey, target this guy. He opened a 10 million long. He has no clue what he's doing. Let's take his money. And then they push price one time lower, and this is not like predefined. That's why low time frame is a little more random, and so you should risk less. Your win rate can still be high on low time frame, don't get me wrong, but the less alignment you have and the less you look for confluence and really higher time frame alignment of everything, the less likely it becomes. Because on higher time frame, everything is programmed, or at least it seems like. So it's really beatable. You can increase your win rate to a very high level, while I said on low time frame, you have more randomness. And if you wait, or if you backtest, or if you like decode those charts, you can also, you need to include majors into the equation, because without majors, oftentimes the level seems like, wow, the level worked perfectly, but why? So it was maybe an altcoin trade, but what was Bitcoin doing? What was ETH doing? What was like USDD doing? All those things, they're so important. And by only looking at, for example, one trade, one altcoin chart, it's very hard to understand why this level works so much better than another one. And then obviously, as at the time frame, um, and then also the randomness of the market. As at also higher time frame level, you can have perfect alignment. We can go long here, and the level still fails. We just like teleport to the next level, and nobody knows besides the ones who like really move the market. And those people won't tell you because they target us, right? um, and for them still they also need to like play inside the rules of physics, or more or less market physics. It's buying and selling. They also can just bend all the rules. They simply can act within this framework of the market. And they know, or we know, that they usually like to play around those levels. So this is high temperature supply. Why? Because we see whales were selling, in this case, USDT here and again. So we can expect they might do this again, but we can never be sure. And that's why we manage risk. How do we take faces from dices? Um, uh, um, yeah, it's confluences, and it's by being selective. So, for example, the thing we talked about before, like you said, higher time frame discount, premium, breaker block time frames, all of those stuff, breaker trend line. You can use execution tactics, order flow, asset. Like increasing your win rate is mainly by being more selective, by really understanding the market mechanics, understanding whales footprints, aligning your ideas with higher time frame context, because as said, higher time frame context is predictable, more predictable than lower time frame context. And this is simply the most important stuff, in my view, that you align yourself. If you want to increase your probabilities, if you want to remove like sides from the dice, you need to align yourself with higher time frame structure. And then you be a little more selective. You take more things into account, so you don't like simply rush into a trade. You wait for the break of structure, discounting, everything, and on the same alignment on higher time frame. All of those things, the boxes you tick, should also be ticked on higher time frame. Then you look at those majors, and that's basically it. And as said, for example, I like the execution tactic with the trend line. Sometimes I include order flow. And there's also this, sometimes I simply don't enter the trade. Everything aligns, but I don't enter the trade because I don't get my like execution signal. And it seems like hesitation sometimes, and maybe it is. Sometimes I'm a little bit overcautious, so this is always the case. But this is also the reason, maybe, why I never burned a single account. Um, and I rather miss out a trade than burning like unnecessary money, right? And obviously, it's not nice if you get like, if you say like, okay, manage my risk early, I get out, and then it suddenly like moves in your direction. Whatever, it's not nice, but it's still not really a loss, compared to like taking like a big hit within a few seconds because you don't like have any execution tactics. So this is, but this is my approach. Your personality might be very different, but um, usually people that like ask me or ask my for my approach, they are also a little more risk averse than over risker, and so you might be doing well with execution tactics. But in the end, I don't know you, so we will figure out. You will figure out, I guess. There was one nice conversation in the Markets Wizard book where one trader in a firm told the manager something like along the lines, "Will we reverse here?" And the manager said, "You sure?" "We will reverse here." And the manager said, "You sure?" And the trader asked, "Yes," said 100%. Then the manager called the broker and told him to sell hundreds of contracts, and that broke the super support level. Have you ever used footprints? We will reverse it. Yep, 100%. Yeah, 100% is nothing is 100% in this market. Besides, if you move price, you could maybe talk about 99%. But the thing is, people also have the impression that if you are like a market mover, you have no risk. But this is not true, because if you put in your millions and some other market mover dumps on you, you're fucked as well. And it's not like they're all best friends and they sing kumbaya around the fire. It's a very competitive like thing. It's about money. And so also they face risk. And I also remember the sentence of Ray Dalio. Um, he said when he gets a new guy into his company, um, he wants to. It's not totally related, but it's also, you brought this thought up in me. And he tests them more or less if they have their own opinion. And he simply does that. So, for example, he then questions him, "Are you sure? Are you sure?" This is not how our company does that. He says this to those guys in the beginning. And if they say like, "Oh no, yeah, no, we don't do that," okay, yeah, good, then we don't do that. He's like, "Okay, you're not the right guy. We need people who think for themselves." And this is like one of the biggest investment companies, if not the biggest, I'm not sure. And he's looking for people who understand the probabilistic nature, and looking for people who are like thinking for themselves and not accepting the status quo and stuff like that. And why? Because even he knows, as the biggest asset manager, one of the biggest asset managers in the world, it's probabilities. And you need people who like can read and be creative, and not like just follow blindly some rule set, because it always was like that. Yeah, so that'll drift away, but I think also important. If you ever used footprints or just CVD, funding rate, or whatever you can find in Coinalyze, I use footprints not for a trading purpose, but for understanding what's going on. So I spent a lot of time. So first of all, I used exocharts a lot for Delta cluster and Delta in general, and it's pretty much like footprints, right? Um, Let it load real quick. And it's oftentimes very interesting to see, for example, if you use this, and we always talk about FVGs, order blocks, and blah, blah. But the question always is, do people really understand what it means, what an order block is, what an FVG is? A fair value gap, right? It's a fair value gap. And what does this really mean? And let me change this so it looks a little bit nicer. That's all right. Why do we call it a fair value gap? What does this mean on the chart? And what is the difference between an order block, for example? If you look at this, so we can call this an order block, right? It's full of volume, like the whole block is full of volume. If you look at this candle, you see that there are these gaps in between. So first of all, the whole candle is pretty much a fair value gap. And you see there are areas on the chart, they're pretty much empty. And what does price do? Price comes back to fill those empty areas. Up here, you see, empty area. Price comes back, fills this empty area. Why? Because there is like an imbalance in the market, and they can take this liquidity. They want to fill this price. Orders got skipped, traders got skipped. So price comes back and fills those orders. And this is why we call it a fair value gap. And you see, gap, no liquidity, no volume, and behind we have something here, and there is volume. And so you can use them to refine, even though, as said, it's not my type of thing. Also here, we fell through and we pumped up without like really touching this area on the chart. If you imagine the order book, I also uploaded a video into the course. If you didn't see it for until now, make sure you check it out. We can also talk about the order book, no problem. But if you understand the order book behind and how it's structured, like limit orders, market orders, you see how untouched this area on the chart is. Here, we only talk about buy, but we probably need to compare a few exchanges. But this is why we call it a fair value gap. And there is demand here, but demand was skipped. Many traders got stopped. They traded demand, they got stopped probably. Then we skipped up again. Many break block traders got stopped again. Volume here, you see, but within here, basically no volume. So price has an interest to fill this inefficiency, come back and retest the level. And so as said, I like using those volume footprints for understanding the market, but I can look at the candles to decide or to define where the volume was or where not. I can use it to maybe like confirm it, but I don't really need it anymore. But I used it a lot to understand those things. And to me, it always was very important to understand what I'm really doing here, because most people simply they see a block and they execute. They don't really understand what's going on behind the curtain. And for some people, this might be not important, but for me, it always was important to understand what's going on. And the beauty is, once you understand what's going on, you can simply shift once something changes, once something is not like step one, step two, step three out of the rule book. You can simply improvise. And if you don't understand it, you can't. Execution tactics, order flow. Yeah, I like them, even though I don't use order flow a lot right now. Because as said, also with order flow, to me it was important to understand things, but now that I know how the market works, I look at the plain chart and I mark some like fibs and blah, but I can look at a plain chart and I come up with those levels without marking all of them. I can imagine what happens once this level hits. I can see at the wicks or how price behaves what is going on within order flow. I use it sometimes for confirmation, but I don't look at it that much anymore. But it's very, 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 very helpful to understand that stuff. Trade less, earn more. Yeah, not just the phrase. More explanation on compounding. Compound interest calculator, important. Yeah, look at this. Compounding in general. You know what? Actually, let me pull this up. Um, I know we talked about this before, but go give you guys another window here. Okay, so compounding. Also, sorry for for the whiteness of my screen. My eyes burning as well. Um, I also could have used Andy's, you see, but I know this one, so let's play around with this. So let's imagine you start equity is 10K, right? And we talk about a 50% win rate, and then you have a win loss ratio, so RR from 3 to 1, and we take 100 trades and 100 different traders. And for every single trade, you risk 1%, right? So if we calculate this, if it lets me, now here we go. You see this, if you are able to pull these statistics, which means 10K start, 50% win rate, 3 to 1 RR in general, 100 trades from 100 different traders, means an average of, after those 100 trades, you're at $25,000 in average. You have outliers, obviously. You have some at 35,000 and you have some at like 10, 11, 12K. But the average is very profitable, I'd say. And this is what you need to understand. First of all, compounding, but also like the statistics of win rate and risk to reward, and like simply by compounding a lot of gains. I mean, 100 trades is a lot, right? Especially if you trade a higher time frame, and a 50% win rate is also not that bad. So good traders usually have a 50% win rate. So if we change those stats, so for example, let's say you just play a 30% win rate. Oh, no, one more important thing. Here we have still like the 50% win rate, so I didn't like start a simulation. Means we have consecutive winners 11 in a row. This means you can win 11 times in a row, statistically speaking, on a 50% win rate with 3 to 1 R. You have also consecutive losers, 16. I mean, think about it. 16 consecutive losers. How many people could still be executing the same strategy? Even though you know, for example, you have these stats, you have 50% win rate, 3 to 1. This is not the problem. If you can stick to the system, that's not the problem. The problem is that after 16 consecutive loses, you won't stick to the system anymore. You will make emotional mistakes and all that kind of stuff. And that's the main problem. The compounding effect, if you can stick to those statistics, is still insane. It's amazing. But the problem oftentimes comes then from the mental game, and then it rather looks like something like that. Too early TPing, all that kind of stuff. Still maybe a 50% win rate. If we talk about like, okay, still a good trader, 2 to 1 win rate. You see the consecutive winners and losers do not change that much because of the win rate, but the results are very different. So it's only 16K in average, and you also have some traders entering drawdown. And this is still on a 50% win rate. Now let's imagine you go down to a 30% win rate because you've messed up a lot of like trades. Then suddenly the equity curve looks like this, and you compound more or less your losses. So the average is then like at 9K or something, and some traders like even burn 3K in the process. And you have 21 consecutive losers. So this definitely will lead to a lot more losses than just this, or you even quit. And if you play around with those numbers, you will see that this becomes ugly very quick if you don't understand the math behind it and if you don't stick to the system. But if you like good and you play a 50% win rate on 5 to 1 hour because you play high time frame, look at the compounding curve here. We talk about an average of 60K. This is a 6x from your 10K start account, and it's 50% win rate, but you still might enter like a 40%, a 14 losses, losing streak, right? Don't forget that. And I mean, 14 losses in a row, it's like things must go really bad for that. But let's imagine just 5 or something, 5 losses in a row. It doesn't feel great. Many people abandon the strategy, get emotional and stuff like that. But in reality, max equity here, the best trader, even achieves 130K. It's possible. The math is there. But we need to stick to this math. And this is like what compounding really means. In this case, obviously, the risk gets increasingly bigger. So you start with 1% risk, which is $100. And obviously, if you do this, at the end, it's $1,300. So you also need some balls for that to achieve such goals. But like somewhere here is still our amazing results. And we can also like change the risk a little bit, and then obviously becomes even heavier, but 1% is already good enough. And then, for example, let's think about 1,000 trades because you ask about compounding. So let's say we take 1,000 trades. Look at this curve, and maybe we need to make it a little more realistic here because of TPs and stuff like that. It's usually not a 5 to 1, but even on a 3 to 1. I mean, look at this. We talk about 2 million after 1,000 trades if you can stick to this strategy, but 19 consecutive losers, or also 16 consecutive winners. How many people scale up, size up, get euphoric, get like stupid once they win 16 times in a row? Probably most. And that's all. These are like the variables in the equation that people can't handle. It's not the math, it's not the compounding that's getting it wrong, it's the human component because of those numbers. These two numbers, they hurt or they make you euphoric. Well, I said it before, I'm not that selective yet because I want to get data then to refine based on more understanding. Obviously, I don't take random blocks, I have rules, but I'd say they dumbed it down pretty well. Because if I was studying all day and not executing, I would miss the plot. Yes, and as said, in the beginning stages, I just go back to TradingView here because it's hurting my eyes. Here you go. It's good that you like that you're bold and you simply take trades. And I know you manage your risk well and you play on low size, and that's great. Just execute, collect experience. Just make sure you collect the right experience. Don't build emotional baggage by doing like stupid stuff. But I know you don't do that. We talked about this before a lot of times. So this is not your thing, but I wanted to say it anyway. and then becoming more selective with this experience, because like if you only take higher time frame trades, the whole execution side, the whole emotional side, how to handle, for example, those exchanges, um, takes a lot more time. Obviously, if you want to get 100 trades under your belt, it's wise to do that on like not so optimal higher time frame levels, because otherwise it takes you a year or two. But it still should serve your goal of like building proper experience and not like wrecking your mental game in the early stages. This is the most important stuff part. And then once you feel like, okay, I got enough experience, you can then play high time frame. And the thing is, in the beginning, you should always be very, very careful with your risk. But once you found consistency and once you see, okay, I know what I'm doing, you can simply scale up those most optimal plays. Those don't come around every year. I mean, for example, let's imagine we enter 1 year bear market, everything goes down aggressive. If I buy major assets, I won't just risk 1 or 2%. If I want to go big on those moments, I go big because the risk to reward is insanely good, and I'm also willing to risk a little more for that. But I'm confident in my abilities. I have collected data by collecting experience, by taking a lot of also not so optimal trades, and then once those moments come, I'm prepared more or less. But you can sometimes you wait years for those, obviously. I think many underestimate compound interest because it's hard for people to not think linearly. That's what we do generally, exactly. But compound interest is exponential, hard to grasp for the mind. Hello Nova, by the way. If someone wants to dig a little deeper on the graphs Max just showed, you could look up how Monte Carlo simulations work. Never heard about that, but yes. What Max just showed on the 1,000 trade example, hard to imagine. Yeah, it is. It is actually. And also, it's not how the human mind works, because those are like plain math, plain statistics. You have like 50% win rate, you have a 3 to 1 R. This is like perfection, right? This is how a computer would like do it. But the human equation that we add, that we are like the emotions and all that kind of stuff, it's not it. You can't calculate that really, and you can go in with good intentions this week, and you make some experiences in your real life or whatever, and then suddenly you're a different program more or less. You are not the same old program computer that can execute the same thing again, because you change. And yeah, the human mind is not a computer, for most at least. What does this really mean? If there's no significant imbalances, there will be obese in supply and demand fresh levels. If there's no obese supply and demand fresh levels, there will be significant imbalances. If there's none at all, there will be a wick into fresh levels and build a new trading range. It simply means if there is nothing to drain anymore. So if we looked at the volume footprints, right? So there is an imbalance. Price wants to go back to this imbalance and take it. And once this is filled, there is no reason for price to go there anymore. It could, obviously, it could always do anything, right? But it probably then won't go back there. So you decrease likelihood. And then you order blocks, supply and demand, all of those kind of things, fresh levels, not just wick, not just swing failure pattern and all that. The more often those levels and areas of interest get touched, the less interested whales or institutions are to push price back there. And once all of the range is pretty much drained, so once all imbalances are closed, um, price will simply create a new trading range, because price usually ranges until the range runs dry and nobody's interested in taking longs and shorts anymore. You can observe this in order flow. So for example, everybody's very excited here on ETH. Everybody's highly excited. We go up, down, up, down. You see a lot of positions entering here, longs, shorts here, longs here, shorts here. And then suddenly it becomes boring to people. They got wrecked, they maybe got no money anymore, they lose interest. And then they do this, and people suddenly do something again, and then they do this, and they create moves to attract liquidity. And you can see those footprints and their intentions by looking at fair value gaps, order blocks, all of those things, because these are the footprints whales leave behind. And as I said, I used order flow to really see what they are doing. And as I said, once a range runs dry, they create a new one because nobody's interested in taking positions anymore. For example, so if we let's imagine we go up here. So there are plenty of reasons why price can go up here, right? So we have this untouched area, we have this untouched supply area, we have some FVGs here, we have this FVG here. But once these are all closed and we fail to like create a new range to the upside, it becomes more likely that we go to the downside because there is then more interest for price to go. And if you put everything into context, how people think, psychology, cycles, all of those things, it will make a lot of sense. Yeah, so I think this covered everything so far. Is there something like from all the things we talked, is there anything unclear? Is there anything like questions remain open? Something or something you want to dive deeper into? Because I could simply start ranting around, but usually it's more helpful if people tell me what I should rant around about. Also, if one of you want to share something, a trade, a chart, or whatever. Oh yeah, refining. Let's talk about refining. So let's stick to ETH and look at this level. It's also good because we talked about this. We talked about this today as well with the footprints. But we, for example, we see this as level, right? We want to trade this. Why do we want to trade this? Because there is an imbalance. We are in this demand. So this is like a big demand. Consolidation led to a big impulsive move. So we could mark this as demand, but obviously we don't want to go long here at the beginning of the demand, having a 30% stop loss. It's not what we want. We want to refine. And so we use levels inside here to refine. And why do we use this level? It's not just because there's a block behind an FVG. It's mainly because there's this FVG. What is this? There's a trade. Mainly because this FVG here, because this is a gap in the chart. Then if we go down to the daily, we see, there is still a gap in the chart. And then if we go down to the 12-hour, still a gap in the chart. 8-hour, still a gap in the chart. And the lower I go now, and we see still this gap here. You see also like we have the block behind. We have not just FVGs, like just FVGs behind each other. Usually they need something kind of behind them, which is also this block. We overshooted it. So this is why over refinement usually does not lead to anything good. It's more or less just greed disguised as technical analysis. And now we are at the 6-hour, we still see an FVG behind here. And also on the 2-hour and also on the 1-hour. Now it gets interesting because if I remove those two and we look at the 1-hour and there's still this FVG, right? So even you need to consider like this FVG on the 1-hour is very powerful, even though it's not higher time frame, but it's telling us that price was moving so fast in here, so freaking fast that lots of orders got skipped. Wait aggressively market order to push price through that level, even on the 1-hour, and then we could even go down lower. And we see on the 30-minute, we still see an FAG, and maybe even on the 1-minute. if I can go back this far. Am I already too far? No, probably not. Probably not even close. So let me make it that replay mode. And we go here, and then we go for the 1 minute. Probably I should probably mark it the 1 hour first. So this was, it's still the FVG in our demand here. So let's mark this and we go back to the 1 minute. Now we see even on the 1 minute, it's a big freaking FVG, like massive. This is definitely whales footprints. Like, I mean, 1.5% on an asset like ETH is nuts. I mean, this is huge amounts of money that like were pushed into this 1 minute candle. And this means this whole area here is super, super liquid, because once we come back, there are resting orders, resting whale orders, interest of whales to push price high again, defend their old orders, whatever. Many reasons, and we don't even need to know why. So or we can't really know what is really like the reason why price reverses here. We know it's resting orders and whales again willing to buy here. And you see, this is like the whole refined thing on the 1 minute, and it's going down there and even further. It's closing the whole FVG down here, and this is why over refinement often leads to unnecessary stop losses. Still, this is what refinement is all about, to see where the most amount of liquidity was flowing and the most aggressive one. And we can then also use the volume footprints to get a better understanding. And if we look at the FVG again, like we did before, why is it not showing me anything? It's probably because maybe it's not loading. Maybe maybe the 2 hours to. Maybe I need to set it to auto. No, it's because of the time frame. So if you got this problem, you need to set it to automatic, then it should be all right. Makes no sense. That's why I use ExoCharts for something like that usually. And here you see empty areas on the chart. I mean, even zero. That's how empty this FVG is. And we know that already by looking at the 1 minute and even seeing that there is an FVG as well. Price was moved so aggressively through this area where it's market order pretty much up here, and they completely skipped price. They completely violated this area of the order book, and then that's why price came back to this level, because there's this big imbalance on the chart. And as I said, there are many ways to get to see this, and you can do this by going down to the low time frames. You can use volume footprints, or you simply look at the candle while it's moving. And this is also something oftentimes, for example, when we decoded monitor charts in the group I was early on of traders, we started like decoding his charts, and oftentimes we were like, why is he like marking this level? Why is this so important to him? First of all, we don't know what's going on in his head, and second of all, he maybe was even around to see how price action developed live while he looked at the chart, and he maybe was on the 5 minute and he was seeing like, wow, this is a crazy violent move on the 5 minute, and so he remembered that and he marked it out. And once it came back, he knew, okay, this is a good area. We couldn't do this by looking at timeframes, by looking at those footprints. There are many ways to get to the goal, but you could then refine this down, and that's why I meant like it's not always the block down here that's so important, it's the FVG that's so important, and we use the block as confirmation and maybe even also as refinement, but in the end the most important thing is the FVG, the FVG in my view. And that's also, if you enter down here and like cover the whole FVG, I mean, it was still like overshooting quite a lot. That's why I'm not a friend of over refining. I'd rather play a safe 3-4 hour setup than getting stopped on 3-5 hour setups. But it's a personal preference. But I usually tend to completely cover all FVGs. And in this case, You could have waited instead of entering up here, you could have waited for down here and you get your better entry, your tighter stop loss, which is then refinement, right? If I drop to a lower time frame and the FVG disappears, does that mean the setup loses quality since the healer would be wicked through, right? Yes, and no, because I mean, if you trade, for example, a monthly FVG, you might not find a FVG on the 1 hour. But is it really that important? No, because in my view, no, because you trade a 1 month level, for example, I would never go down to the 1 hour to refine. But if you go for example, to the daily down, and you see in the daily there is still a gap, okay, I can refine this a little bit. Makes sense to maybe not enter at the top of the level, but rather say, okay, good, it's a little bit lower. There's still like big FVGs on the chart, so maybe I can get in a little bit lower. But what I like even more than that, so this what I'm showing you, what I've shown you here is not what I usually do. So I usually have my area of interest, which is then the 2 day, and within this 2 day, I basically wait for a price to hit and then I refine my entry once the level is hit, if I want to refine. Because in my view, this makes the most sense. I have my general area of interest and then I refine with execution tactics once the level is hit. But there are many approaches to do that and to take trades. That's why it's best to play levels that can be refined from higher time frame, mid time frame, low time frame. If you see it in all time frames, you can see, okay, where they're active. Yes, you can do that. As said, many ways to approach this. But still, it's also not a guarantee that if you find a level on all time frames that it's going to work perfectly or something. But yeah. But the one thing I'm not talking so much about refinement and all that kind of stuff because I see people chasing the perfect refinement instead of like playing like good solid plays. They chase crazy R, the perfect refinement, the perfect strategy, whatever. And so many things don't really make sense to me because it could be way easier. You could save time, and many people chase the perfect refinement but take so many stops, and this like wrecks them early on so much that they have this emotional baggage all the time, and all of this to not even outperform majors. Yeah, it's not really worth it in my view. But hey, as said, many approaches to the market. I always looked at it from another perspective that drove me crazy. I always looked at it to get super high RR plays and getting around the 1 minute block to get giga high RR, but we would have just get stopped, right? Yes. In this case, if you enter on a low time frame and say like, wow, this was 1 minute FEG and I entered this and super refine and blah, it would still be overshooting. Why? Because there is no perfection. And the market is an emotional market. Nobody can tell once, like, look at this move down, right? How many people got liquidated? How many people got fearful spot selling, liquidations, blah. This is like an emotional market. It will overshoot sometimes. This is not like you could predict this like rocket science. Then you have 5 different exchanges, especially on the 1 minute. You will see that on all of these exchanges, price reversed at a different level because buyers stepped earlier there in, sellers were more aggressive there, and all this kind of stuff. It's so much randomness also, and especially too low time frame. So don't fall for over refinement. It's not helping in my view. When you decode a monitor and not try to trade only those one blocks yourself. Yeah, okay. Yeah, and this was also, as said, I was in this group of traders. You might know some of them from X. And we spent a lot of time decoding those charts and analyzing profitable traders and stuff like that. And we also thought like, what is going on here? Why is he marking this? And we couldn't really find anything. But first of all, we don't really know. So if you look at a trader, at a public trader, you never know if he's always sharing everything he really knows and does. Because sometimes many things are kept secret because for whatever reasons, because if everybody knows them, they won't be as powerful, or to sell something or whatever it is. In the end, we never really know 100% what's going on. And we also found levels on the chart and we were like, why this? Why this? And as said, oftentimes maybe also because he was live there, seeing price action develop, maybe even sometimes because he has intel, or a person has intel we don't know about. so connection to whales, whatever. There are so many variables to something, and falling for this like need for perfection to have every single like puzzle piece making sense. We spent a lot of time with that, and usually did not lead to better results. Um, so yeah, but everyone has its own approach of also learning those things. And for some people, it might be very important to spend time with thinking about that. So I don't want to say it's useless, but it never like led to better results for me. And that's why I also don't refine too much. At the right time with the right setup, I try to go to increase my R, obviously, but it's a nice extra bonus. I don't need a 10 hour setup to be profitable. Can you show refinement when we get into a level apart from entering on the downward trendline break? Maybe we looked at it last time and I'm confused just by the wording. So, I mean, crypto is a little bit different. My main thing is basically the trend line, right? So it's not a big secret or anything. It's it's really the trend line. But in crypto, as I said, it's so-so with the trend line. It's not always the best thing. And we also talked about volume spread last time. And I don't have an actual like um, let's go for Binance, an actual example for this long setup, but I can show you like textbook volume spread analysis on the BTC chart, on also maybe on another stock chart or something like that. It's always pretty much the same. You have a supply level. In this case, this was our supply level. We also saw before that it aligns with the 0.5 of the range. And we go for this level. And you see how price violently goes up. And it hits the level first time. Big, massive candle into the level on above average volume. I like for volume spread analysis, you can also put on your MA. So it shows you like the average volume. And you see how price enters with a violent FVG, almost the level. Then we enter the level and it's on higher volume, right? Higher volume, big wig at the top. Volumes, classic volume spread. It's not, it can't be more textbook. And this means we have effort made above average effort, and we have a above average, a candle body above average. So it aligns, right? We put in more effort, we get more result. Here we put even more effort in, but the result of this body is like very small compared to this one. And this following the other candle is like a textbook sign of absorption. Somebody is aggressively offloading here with a lot of volume, and the result is pretty much like not negative, but the result is not what you want to see with so much volume. So there's lots of sell volume going on. We could also pull these up again, and then we see it. But for now, let's stick to those candles because we don't really need the volume footprints to see that. You can also look at candles and simple volume. You see, same here. Not as textbook, but still like we touched the MA, so it's almost above average volume. It's higher volume, at least compared to everything else here. Big wick at the top, small body. Again, here we have high volume, high effort, like big green candle, so makes sense. Everything aligns, no divergence. Then we have way higher volume than the candle before, and really above average, right? So this is like the biggest volume we have seen all throughout this range ever since down here. And look at this candle, look at this big wick at the top, even a negative result after this big green candle. It can't be more absorption than this, right? It can't be more absorption. So there were like several signs. So if I would be a low time frame trader, this would have been my signal. And it's also textbook like distribution here, taking all of those stops again, and then you see what happened right after. So taking a short here would have made a lot of sense, but this is not my type of thing. I don't need don't need that, whatever. And now we can look at the current price action, but we don't get a clear signal. And this is also important stuff. If you try to like use execution tactics, autoflow, this kind of stuff, don't force it. Sometimes there is no signal. Sometimes there is a counter signal. Sometimes it's opposing signals. Be a little bit flexible here, right? I've shown you this example because it's like really textbook. If you see this within a supply level, it's perfect. but you won't always see it that perfect. And for example, here is not really something going on. We have, I mean, this is screaming lower, but it's mid-move, so it's not really tradable in my view. Also this here, it rather like showing absorption at the lows, but it's going down. Important stuff to put it into context. If you see this candle, you don't randomly say, oh, volume spread, I go long. No, it's still in supply, right? Not a level you want to go long. And here mid move, we like get a volume spread candle down. Not helpful, not tradable in my view, or not at least not for me. Let's frame it like that. And then we have this liquidation candle, which is obviously on higher volume because I had a look with a Menti today on the on ExoCharts, and it was on Binance. It was 200 million in longs liquidated, so the volume is obviously above average. The wick is not that impressive, but I've seen in ExoCharts that a lot of volume was down here, so a lot of longs got liquidated into the FVG, into the discount of this move. So liquidation candle also something, nothing to do with volume spread here, but also something you can use order flow wise to use those. Let's maybe the data is accurate. We can compare it right now because I know it was 200 million and it's 1.22k delta. It's probably in BTC. So 100k x9 is 900k, adding a zero, it's 9 million, right? No, I need to add like more zeros. Give me a second. My brain is already a little bit cooked. So we have a price of 90,000. So we add 1 0, 900,000. We add another zero, it's 9 million. We add another zero, it's 90 million. Negative delta. Am I correct? So it's 1,000. So 90 million. Yeah, roundabout. Okay, it's not what ExoChart says, and this is what the problem with those volume footprints is. I heard already that there are estimates, and compared to ExoChart, ExoChart is way more precise, and it's not completely aligning here, but it's still showing like significant sign. I mean, compared to all other deltas, heavy uh, negative delta. And as I said, from on ExoCharts, I saw it's longs liquidated. Looking at this candle, it's a classic liquidation candle, and this can also be a reversal sign. Looking at liquidation candles, not always volume spread, but also liquidation candles. And you see how volume always like increases at pivot points, like at the lows here, longs liquidated, at the highs here, liquidated, where it's offloading. I mean, this candle obviously, and here. So in my view, from an execution tactic perspective, first of all, above everything, the trend line, because it's so plain simple. And without a trend line break, it's not very wise to enter trade. With it, you simply increase your probabilities a little bit without really overcomplicating things. It's pretty easy and it's pretty straightforward. And then if you want to have more, it's probably order flow. Learn about volume spread analysis, learn about liquidations, learn about order flow in general, like longs opening, shorts closing, what does that mean for the market, all those things. CVD can be added. But as said, if you're good and if you become really good in reading order flow, you can at some point simply look at the bear chart and you will see the same stuff without all the data as confirmation. Also here on the daily, you see the volume looks not like on the smaller time frames, but at this high. Why do we, for example, trade with 3 drive? It's a very simple thing, because it creates the impression of higher highs, and higher highs attract buyers. And this is what whales want, right? They want to have buyers at the top. That's why they create this impression of higher highs. And that's why the 3 drive is a very powerful tool on high time frames. And here, volume spread, look at this candle. Like big green candle, above average volume. The next candle, highest volume all throughout the range. Big shade, big wick at the top, small body, high effort, negative result. First sign of an entry. Next here, not that clean, but still, effort made. The candles are pretty much same size. This wick is a little bit bigger, not that clean. And here again, see those small compressed candles on above average volume. Not textbook, but still there. And all of that into context, higher time frame high, higher time frame all-time high, then this, and then obviously the nuke. So there are always signs. And as I said, don't overcomplicate it. Pick some things that work for you. Pick some things that make sense for you, because not all things like feel natural and just flow. Some things are like a little harder to grasp maybe for you. And if it not leads to better results, obviously it won't lead to better results immediately. Then give it a try. Take some time, but be honest. Like if it just like confuses you, or whatever, then don't use it. It's not necessary. But as said, there's very powerful stuff if you're able to read this properly. And as said, I learned all of that by using Autoflow software day in and day out for a year and a half. And now I look at the naked chart and I see the same things basically. It's literally literally a trend line for me right now. Yeah, and as said, the trend line itself is already so powerful. So even though you have no clue about the whole thing, about the volume spread, you see higher time from high, all time high, lots of people bullish. The trend line breaks here. You want to trade the swing failure pattern. You wait for a trend line break. You enter, stop above the highs. That's how I did my BTC short. And I also saw the volume spread here, but still, this would have been definitely enough. Um, Especially crypto at the highs is very, very obvious. Crypto at the lows is usually a little bit harder to trade. Why? Because everybody wants to be long crypto all the time. And so where is the edge? If everybody and their dog want to be long crypto 90% of the time, so getting long with all of those people is way harder than like being on the opposite side. And that's why price action usually at the top and before sell-offs is much cleaner. And so shorting is an edge in itself. And you see it's way weirder price action down here. The signals are not that obvious, but it's there. So you can still like take majors, take the trend line break. There's a little retest. You enter within here, stop below the lows. Let's go. Adding autoflow screenshots to my journal, yeah, can help. And also what helped me the most with the autoflow is also going for lower time frame, going for the 1 minute, and then looking for buyers and sellers to fight. You see how those candles are printed in real time, and you see then also your delta cluster, and you see the delta and the volume all in real time, and it's just amazing. It's like there was a time, I mean, it sounds like I'm a freak, but there was a time where I enjoyed that, like doing this all evening long, like other people watch football or whatever, like watching buyers and sellers fight. I mean, obviously, I started to have a life again, and I'm very happy about that. But it's very, 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 very helpful to go in the low time frames and watch auto flow and price action to develop in real time, because you really see how those, and you also like showed your chart last time where you did that on the 1 minute or whatever, and it's like that. You see like all those intra moves, they are full of these kind of structures. It's always structured, it's all fractals, it's repeating itself, and on low time frames you see that in real time. And then you add auto flow on top, and it's like, as I said, it's like watching buyers and sellers fight. And I like Autoflow so much because you mentioned the book Market Wizards, and there are many traders in there. They learn trading on the trading floor, right? So you are surrounded by 1,000 or 100 or 50 other traders, and they're all screaming buying, selling, blah 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 blah. And lots of those traders, or some of those traders, said once they moved into a office, they lost all of their edge. Why? Because they had no signals anymore. They saw no buyers, no sellers, because they knew if this guy is buying, the market is dumping anyway. And with Autoflow, you make this visible. You go down on the floor and you see people executing, going long, going short. And as said, on the low time frame, it's like in real time, so it can be very helpful. But it can also be very draining, obviously. So keeping it balanced is important. I remember your crow shot as well. Yeah, and the BTC short was very clean. Keeping a journal of other trades and their win rates could be an edge in itself. To be honest, um, I look a lot at other traders and other people's opinion. I mean, not as much anymore, but I told you about this group. In the beginning, we were like a few people, and then we were like 10. and suddenly you know which person is good in something and which person is bad at something. So there are some traders very good in reading market structure, trading lower time frame, but they're very horrible in reading the higher time frame stuff and having a proper higher time frame bias. And you know, if they are like higher time frame bearish, it's time to be bullish. Even though I was good with those people, and it sounds a little bit like bad almost to say I use this person as counter trend indicator. But yeah, I mean, what should I do? I observe people, I observe the market, and suddenly you get some signals if you if you want or not. And also, like being in big groups, also the MMA, I do sometimes those polls to ask about like what people think right now. And once we started the group, in the beginning, like if there was a poll and everybody was bullish, it was almost a certainty that everything is going down. Really, I'm not joking. But over time, and it's important to stay flexible, because over time I saw that those posts getting more accurate simply because people got better. And so if I just kept on doing the same thing all the time, I would have get like wrecked with this kind of indication, because it simply didn't work anymore because people got better. And so everything is always dynamic. It's never like static. That's why the intuitive approach is so much more powerful than having this rigid rule set, in my view, because then you can simply adapt if necessary. And yeah, so as I said, I took a lot of signals out of groups, X, whatever, not just the LARPs that are always bullish, but also traders who really also in some areas know what they're talking about, but in others maybe not. And maybe sometimes you trade with them, sometimes you trade against them. And that's pretty much like those in the book Market Wizard, like those traders explain it, like it is on the floor. Okay, guys, I'm cooked. I'm totally cooked. But it was a great session. I really enjoy that you guys are so working with me, because I did a public live stream today and it's way different. People usually don't ask questions, they don't bring up topics. It's way harder for me to like come up with something. So I really enjoy working with you guys. It's a pleasure. So if there's anything important left, amazing guys. I mean, if it's not something that's taking another like 20 minutes, yeah, let's go. So you wanna ask it, or you wanna explain it? Because then I need to like put you on the stage. Okay, okay. Give me a second. Here you go.
Hi, can you hear me?
Yes.
Uh,
Yeah, we hear you.
okay, 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 sure. That's good.
Hey.
Let me see. Hey, hey. Um, I'm sharing. And can you see my screen as well?
Yes.
Or is that not working?
Yeah.
Okay, great. This chart is really messy right now. I know. But so for example, I also was in this AVEX short, and I am again. If you remember, like last week, I said my head is quite full and I couldn't really think that well, to be honest.
Mm.
And I actually made a C game mistake, I would say, as well on this AVEX long, because I didn't put on um, a limit TP, what I usually do. Because I mean, normally when I go to work, I put on limit TPs just to get a TP. So I missed out on this one, on this TPs. Then we reversed and we got that double hidden mid time frame cluster, I would say. Then we came up again, and I had this trend line drawn, and we rejected of both. Um, here, that's where I TP'd, and I had like this stuff which I journaled as well, that it wasn't mechanical because I wasn't at the top of my game and so on. And yeah, that's like some question I kind of wanted to journal as well. Should I really TP and stuff like that. Obviously, hindsight analysis is, yeah, maybe not the best all of the time. I came up with that this is a reasonable decision, and that's why I did it. Um, but yeah, that's something I just wanted to share quickly. That like I had some sort of mistake because I wasn't at the top of my game, you could say. But I think I still made a reasonable decision. Obviously, maybe wasn't the best one, but yeah, I TP'd here. I had my stop loss to break even, got stopped out here with a small profit, and now I'm in this one. And if it works, it works, and if it doesn't, it won't. Was actually quite cool to see you enter that one as well this morning. That's why I also asked about AVEX, how you look at it, because we didn't have that break of structure.
Mhm.
And yeah, um, my stop is right here below the. I think let's go to the 4 hour. Yeah, right below, where we close like the multi FVG, I guess you could say, multi time frame FVG. And
Mhm.
yeah, I think I just wanted to share that really quickly, that I had like this I get a stupid C game mistake because as I said last time, so much going on right now, and kind of had to pull back a little bit, and that I try to make the best out of it. And yeah, I think that's something I wanted to share.
Yeah, thanks for sharing. Yeah, I mean, we can't always perform on our best. It's not that we are machines or robots. We have ups and downs, and like knowing that and reflecting on that is the best thing you can do. And yeah, I mean, it's still nothing lost, right? So,
Yeah,
but yeah, nice reflection. Thanks for sharing.
thanks. Thanks for listening me for more than 5 minutes now. Oh no,
No,
it's actually five, to be honest.
perfect,
That's German
perfect.
efficiency, right?
Yes. No, very
Okay,
nice, very nice. Great session. Thanks for sharing, and I hope you recover soon. So give yourself time
thanks.
to recover properly.
Yeah, lots of tea, lots of tea. That's, I hope. But, yeah, thanks.
Okay, so we wrap it up here, I'd say.
Yep, yep, fine for me.
Thanks everybody for joining. I wish everybody a great week ahead, or a great weekend actually still. It's a Saturday. And we talk next week. Bye guys.
Bye bye.